Welcome to the Power and Market Report. I'm Albert Liu. I'm pleased to be joined today by Harry Wulfsohn. He's an executive director at Imara Holdings Limited, which specializes in the African capital markets. He's also the founder of Fleming Wulfsohn Africa, and for 15 years he was the director of the Stenham Group, where he led the transformation of the group from a multi-family office with 1 billion AUM to an institutional fund manager with over 6.5 billion in assets under management. He's recently written an article for AfricaGlobalFunds.com called Window of Opportunity, and I'm very pleased to be joined with him today. Harry, thank you for joining the Power and Market Report. How are you?
Fine, thanks, Albert. Thank you for inviting me. Thank you.
It's very good to have you, Harry. And so I'm looking at the article. The first thing that stands out to me is a quote. You say that 2015 commodity slump and subsequent weaknesses in various domestic currencies have created a window of relatively cheap African assets. Now, Africa is a very interesting place, kind of unfamiliar to most of us, the casual investor here. Let's talk about Africa. Let's talk about maybe some of the things we don't normally associate with Africa and how sort of the macro environment has changed.
Yeah, thank you, Albert. I mean, as you suggest, the perception of Africa is generally quite negative. I think people are unaware of what really is happening on the ground in Africa. Just to explain to you, Imara has been operating in the continent for over 40 years, and we have 6 offices and 120 people on the ground in Africa. So we have good knowledge and experience of what's going on the ground, which is often very different to what you read about in the press. You may not be aware, but Africa is the second largest continent on the planet. It's a huge place. Just the coastline of Mozambique alone is the length of the west coast of America. You can fit America, China, and all of Europe in the continent of Africa. So it's a huge place, 54 countries. Clearly, some of those countries are dangerous and places you would never go to. But there are now 25 proper democracies in Africa. There are 15 stock exchanges. Most of these countries have free-flowing currencies, independent central banks, in our experience, are now becoming very investable. There are over 1 billion people in Africa. There's a growing middle class of about 75 million people. India's middle class is only 14 million people, and that's set to grow to about 130 million by 2020. So you really can find some interesting investment opportunities in Africa. Just going back to your question, Albert, what was the exact question?
Africa is typically thought of as a significant player in commodity markets. And so with the slump in 2015, you would expect those markets to be hurt. And as the commodity markets come back, you would expect the growth to return. But what surprised me about your article is that it's more than just a commodity engine. You see that what you call tertiary sectors are fueling a lot of this growth. I think it was up to 50% of the growth or more. So can you talk about these tertiary sectors?
Yes.
Because I think this will be kind of a surprise to the viewers.
Yes, I think as you say, the perception is Africa is a commodity story, but in fact only 6 countries in Africa are commodity exporters. The rest are all commodity importers, fueling the growth of tertiary, manufacturing and other industries in those countries. Only the 2 biggest being Angola and Nigeria, clearly big oil exporters, but many of the other countries have now evolved, where over half their economic GDP growth is coming from manufacturing and tertiary services. By way of example, in Egypt, most of the suits in the UK are now made in Egypt. It's now cheaper to manufacture suits in Egypt than it is in China. French car manufacturers make all their parts in Morocco and Tunisia. A big Chinese shoe manufacturers now building plants in Ethiopia, where it's cheaper to manufacture their shoes than in China. And firms like GlaxoSmithKline are opening operations in Nigeria and Kenya. So really there is substantial diversification away from commodities. And what's important about that is, there's a very large, young, urbanized, educated population, but these young people need jobs to fuel consumption and fuel the growth of the middle class. So this gradual economic diversification and growth in these domestic manufacturing and services industries are fueling the growing middle class and the growing consumption.
Right, and you make a point of saying that the demographics favor a growing consumer class. Of course, this has to be managed correctly. What I noticed also in the article was that The usage of, for example, social media is on a pace that I didn't expect. The mobile phone sector is also on fire. And you have a chart, I believe, that shows that the growth is on pace with what you see in China and India. That's also a surprise.
Yes, I mean, Africa is a classic case of what we call leapfrog technology, where they're really bypassing some of the things that we've been used to in the West. For example, the concept of bank accounts, the concept of landlines don't really exist in Africa, and they really have leapfrogged into the digital age. And most of the youth all have smartphones. Most of the youth don't have bank accounts, but they use their telephones now as their banking and their credit cards. So there's a very famous case in Kenya of a company called Safaricom that owns a system called M-Pesa, which has become the leading mobile payment system in the world, where all the young people have their salaries paid to their M-Pesa system, and their mobile phone is their debit card. So these growth numbers are coming from a very low base, but it's gone from, I think mobile usage has gone from 2% in year 2000 to over 75% now. So it's a very broad penetration, and it's a large part of how people conduct their services.
Right, so we have a service sector accounting for half of economic activity. A lot of foreign investment, I noticed, names that we know out of Europe and China as well. So we can talk about that. European companies taking advantage of the labor force and the capital markets in Africa.
Yes, and what's one of the other unique things about Africa, unlike other parts of the world, you still find companies that have very strong barriers to entry or even are monopolies. And many of these companies are subsidiaries of European or international multinationals. The benefit of a barrier to entry or a monopoly is that these companies have strong pricing power and are able to generate significant cash flow for themselves and for their shareholders, irrespective of the market conditions. So they're able to, and during downturns, they can use this cash flow to invest in their barriers to entry to maintain their market dominance. And in very strong years, they pay out substantial dividends to their shareholders. Many of these companies are multinational subsidiaries, so you also benefit from high quality management as well as exceptional governance in these companies. So companies like Nestle, Unilever, GlaxoSmithKline, Vodafone, Diageo, Heineken, Standard Bank, all these companies have substantial multinationals in Africa, and they're investing in these multinationals much like we are, because they believe there's significant growth opportunities in Africa, potentially higher than they can get in their more domestic markets.
Yeah, and you mentioned names that we're all familiar with, Nestle, Diageo, European names. Seems to be an absence of American companies there. Reason for that?
I think America's catching up. And it's a growing trend. You hear companies like Walmart trying to expand into Africa, and there's a growing trend of that happening, actually.
Okay, and then we also have financials. You say that banks have lagged, although you did mention Standard Chartered, but you say the insurance companies are active in Africa.
Yes, I think if you analyze what Africans need, one thing they really do need is insurance, and there's a growing trend of international investors and international insurance companies expanding into Africa to provide a whole range of traditional insurance products to a growing middle class. A classic sign of middle class activity is insurance. If you're buying houses, buying cars, you then require insurance. So as the growing middle class, as the middle class expands, you would expect insurance to expand alongside it, and it's real evidence that this trend is continuing. And the fact that these companies are investing in Africa adds to our belief and gives us real confidence that what we believe in is really happening on the ground. What you see on the ground is really happening. If you take a city like Lusaka, which is the capital of Zambia, I was actually born in Zambia. I've been going to Lusaka all my life. If you see what's happening on the ground now over the last 10 years, you really are seeing, for example, traffic jams, which weren't there 10 years ago. People are really buying lots of cars. They're building 30,000 square shopping centers in Lusaka at the moment. Those shopping centers are all fully pre-let to European and South African consumer brands. So you really do see, when you go out there, you really do see this growth on the ground, the growing consumption, the growing middle class. And what we're really looking to do is find ways to attract international capital into these trends on the ground.
Harry, you mentioned that you were born there, so I have to ask, you talk about the difference between 10 years ago and today. If you had gone back 15 years ago or 20 years ago, what would you have seen? Seems like the progress has picked up quite a bit in the last decade.
Yeah, quite right. What's actually happened in Africa post the Berlin Wall collapsing in 1989, all the African dictators were no longer supported by either the Chinese or the Russians or the Americans. So they had to take on, the only way they could support their economic growth was to rely on IMF support. So really from 1989, there's been a growing trend of IMF funding, and that money comes with very strict conditions. And these governments have had to adopt the IMF restructuring program. So it's been 25 years of continual investment in democracy, in central banks, in opening up their economies to free market. And I think from about the year 2000, you really saw that trend having positive impacts. And there are about 15 countries in Africa that really have had substantial growth, GDP growth rates of 10+% for over 10 years now.
Okay. And when you say investment in central banks, I assume that you're talking about efforts to stabilize their local currencies?
Yeah, well, it's just, it's all about free-flowing currencies. Prior to 89, you had exchange control, you didn't have central banks, you didn't have democracies. So now they have separated, they do have proper judicial, central bank and governments. They're properly separated, proper institutions that are held to account. And you would not invest in a country if you couldn't get your money out. So you need to have free-flowing currencies to enable to attract international capital. That's a key part of what we look for when we invest in a country.
Okay, and finally, I just want to touch on this because it's interesting. You say that there's domestic compulsory listing rules, and I suppose that combined with sort of quasi-monopoly status of some of these companies makes for strong cash flows and relatively attractive valuations of these companies if you compare them with their American or European owning companies, parent companies.
Yes.
Is that true?
Yes. So the fundamentals on the ground don't necessarily reflect the valuations of these companies on the stock markets, because the stock markets are subjected to global trends. In the last few years, following the collapse in commodity prices, there's been a general global risk aversion. People have been selling their African assets because they're too nervous to hold illiquid assets in potentially more volatile markets, despite the fact that the underlying companies they are holding have got very strong 15% earnings forecast. They're paying out 5% dividend yields. As you say, these are monopolies or duopolies with strong pricing power, good cash generation, low debt, owned by multinationals. So they've got good governance and good management teams. So you can get access to really interesting companies at deep discounts that do not reflect the underlying fundamentals of what's going on the ground. And in fact, by way of, to further demonstrate that, most of these multinational parents have tried to increase their ownership of these subsidiaries. Unilever tried to increase their stake from 50% to 75% last year, offered, I think, a 35% premium to the current listed price, but no one sold because they all understood it's a great opportunity. I know GlaxoSmithKline tried the same thing, Heineken tried the same thing, and investors are unwilling to sell these shares because they're great companies. But the multinationals understand that and look to try and increase their stakes wherever they can.
Is there a limit up to which they can't increase their stakes anymore due to domestic laws?
Yes, I think that's what's unique about Africa. You do have these requirements from the local legislation that a large part of the shares are offered to the local domestic economy. You have to have free floats locally. It varies in each country. Some between 55 to 70%. Maximum share ownership by the parent companies.
Harry, this all sounds good and like an incredible opportunity. I'm thinking if you look at all of these factors, the Africa story could turn into China on steroids. Of course, there are always risks involved, and you hear about these quite a bit, so I'd like to hear it from you, an expert. What are the biggest risks here associated with investing in Africa?
You're quite right, Albert. I mean, we've just spoken about all the upsides and all the opportunities, but they clearly are they can be substantial risks of investing in a frontier market like Africa. I think people will be surprised that the general questions I get around risk is always around corruption, governments, disease, war. All those issues are absolutely not the risks that we face. We never get involved. We've never experienced or get involved in anything linked to corruption. The biggest, I think that potentially could happen when you're dealing with very large government projects. You can really invest in Africa without any links to corruption. The two biggest risks that in our view, you face when investing in Africa, one is liquidity. The underlying assets are not as liquid as you would expect when you invest in markets in the West. And so, Africa is certainly a long-term investment. It's not something you can invest in. It's not something you can trade in and out. You've got to take a 3 to 5 year view and, really believe in the underlying fundamental growth story in Africa and benefit from that. It is an illiquid investment. And secondly, currencies. The currencies in Africa are much more volatile than we would expect in the West. And given these quite small currencies, it's hard to hedge. So you can erode your returns through currency volatility. But really, firstly, favoring companies that are multinational subsidiaries, those parent companies have the same objective as us. They want hard currency dividends. So in our view, the best people out there that are able to manage the currency volatility are the management teams of the domestic companies. So Unilever subsidiary, Nestle subsidiary, Diageo subsidiary in Nigeria, for example, those management teams really rely on their ability to manage the currency issues and pay out good hard currency dividends. But I think, if you take a long-term view in Africa, and as we've discussed, you do get there are the fundamental growth trends in Africa are very robust and sound. The select countries are growing and expanding. And by investing in these sorts of companies, you can benefit over time from the significant growth opportunity.
Yeah, so you're talking about liquidity risk, currency risk, and needing to take a kind of a longer perspective on this. This is not unlike the situation in India, actually, not very long ago. So I think many speculators did very well in India, are comfortable with those types of risks. But I am a little bit surprised at how quickly you sort of dismissed the corruption theme and other concerns. Why do we have that misunderstood, I guess? Because that seems to be primary on the minds of most people over here anyway.
Yes, I think Africa suffers some bad PR. And unfortunately, there's been a big focus on the wrong things that are going on in Africa. And there clearly is corruption. There clearly are non-democratic governments. But you can get access to interesting opportunities by avoiding those issues. As long as you aren't dealing with big government projects, you're dealing with real logistics. Like anywhere in the world, you're backing good, trustworthy, clever people. What we're looking to do is find well-run businesses with experienced entrepreneurs on the ground in Africa and really backing those people. As you would do in any country in the world, you're backing good people. And as long as you do that, you can avoid a lot of those risks.
All right, Harry. On that note, I think we'll leave it. I want to tell the viewers you can check out Imara at their website, Imara.com. The article, which I thoroughly enjoyed, was published by AfricaGlobalFunds.com. If you'd like to copy, email me. I'll send you a link, email editor@sprottmedia.com. Or feel free to contact Harry directly, harry.wulfsohn@imara.com. Harry, it's been a great pleasure speaking with you today. Thank you very much.
Thank you, Albert. Really appreciate it. Thank you.